Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, May 15th, 2019, and we have the ongoing U.S.-China trade showdown over their trade deal. Markets in a pretty ebullient mood. Yesterday we had this sense of a slight softening. If you look at some of the rhetoric, Trump saying that some retaliation is okay, and China as well issuing somewhat, at least in official international channels, somewhat softer rhetoric. Although some of the sort of noise in the mainland press looks a little bit less friendly. Interesting, overnight we have this industrial production and retails data missing by over 1%. A bit unusual to see the scale of miss on what many see as somewhat manipulated Chinese data. Steen, chief economist, what do you see? Is there a signal value in this data coming in as weak as it has?
Not signal value, but I think it goes to the root of our main macro theme, which is a false stabilization. I think the global policy panic that we saw early this year was to lower interest rate and to stimulate the economy through the usual channels. And what we said and continue to say is that this transmission mechanism into the real economy is very, very weak. And if you look at the actual numbers from China at the breakdown, it is the private sector which is not picking up. The public sector is picking up, but the private sector refused to pick up.
Reflecting the car sales, those incredible car sales numbers we've seen this year as well.
Car sales, but also the fact that in China, 20% of the economy is the private sector. They create 80% of all the jobs. So as soon as they are ahead, you get the the transmission mechanism into the Chinese economy weakening.
All right, and then we have, of course, despite the very large move we've seen in the Chinese currency market, apparently complacent. Now that we have this, I think some people would feel a delay until the end of June G20 meeting before we see any major developments if Xi and Trump do meet on the sidelines of that G20 meeting. I have a chart here showing the dollar CNH. We saw the day before yesterday the largest move in quite some time. I've also brought up the idea: is the CNY in play? Could China use this, teasing perhaps the 7 level before that meeting, just as the U.S. is threatening tariffs? Steen, do you have any angle on whether they'll actually take it beyond that level or use it as a negotiating factor? I think they already are by signaling where it is now.
Yeah, so yesterday there was some official channels that communicated that the currency would not weaken significantly beyond the 690. 7 remains the line in the sand. I think it's relatively simple as a trader to play the CNH, in the sense that as long as you're below 7, you play long CNH. If you're above, I think it's all hell breaks loose. And don't forget, back into your own instrument, I think the dollar CNY has been the main reason why the volatility has been so low overall.
Yes, definitely.
But as a policy tool, yes, they're aware of it and they're playing with it. But right now, and as long as we are safely in a safe distance to 7, I think it's a non-deal.
Kept a lid on it, kept a floor under the currency. Places where there is some speculation, clearly, and it's hard to avoid linking this with fears on the CNY. Gold to a degree, and especially Bitcoin. I've got a couple of charts here just for perspective. We talked a little bit about that gold squeeze, a very clear technical line in the sand. There were likely some stops lined up there ahead of the 1300 area. That's not been a runaway move by any means. That was one big up bar. Let's see where that goes. But if you look on the right, you see the Bitcoin move, where we've seen tremendous acceleration. The time it took to get from 5,000-6,000 to above 8,000 was basically a weekend plus a day. So I think a lot of that clearly coming out of China, and interesting to watch that as a safety valve or a frothy market over all this. Looking at equities, we're seeing a rather hopeful market here. Do you think that there was one tweet I think you passed along this morning, Steen, this idea that Trump has a much softer negotiating position than what his loud tweets would suggest, and that in the end the stock market is always going to discipline him? What's your feeling on that point of view?
Definitely from the Chinese side, they see the whole softening stance by Trump as soon as the stock market started to crater. They see that as a weakening spot for him. They see his position is weakened, that he will have and will be penalized immediately by the market as soon as he steps up the rhetoric. And at the same time, which I think it's important to note, that if you look at domestic propaganda as it is in China. It is very, very nationalistic. CCTV, which is the official TV channel in China, is now using directly the word trade war. That was banned from being used prior. You see that Xi Jinping and the opening of the Asian culture event this morning is talking about how different foreign cultures should not dictate other domestic cultures how to behave and act. The whole rhetoric has changed dramatically. And I think what to me is most significant is that all the tweets you were referring to is now increasing from the Chinese side. So it's not the Chinese government, let's put that straight, but it is all of its mouthpieces, the global news, People's newspaper, all these editors are all of a sudden tweeting very, very, very highly and frequently, which means that they are trying to understand that this agenda is also set, at least in terms of the rhetoric, is set on the social media. So we've seen a significant ramping up of the communication that we get indirectly from the Chinese government, which I think is a massive change to the way they played it. They played it very soft, almost too soft, some people would argue, inside China, but now they are ramping up both.
Seems like all this risk of generalized escalation, it sort of becomes its own phenomenon that takes on, it goes beyond what Trump and Xi do, it goes to the popular level, obviously. Yeah,
they want to win the popular sort of vote, but also I think the Chinese are realizing that the G20 meeting as a venue is going to be a very difficult place to achieve anything. Don't forget that prior to this becoming a main topic at the G20, the main topic prior to that was actually the WTO, the very WTO, which is not right now functioning because Trump is vetoing the arbitration judges that sits on the WTO. So in other words, the WTO is not capable of actually doing its job. And why is it not able to do it? Because US is doing it. So now we are being told that that meeting where Trump again is going to attack the WTO, he's going to have a sidebar where he's going to agree with Xi Jinping. I think the Chinese have seen through this and see this as a very difficult venue to do it. Nevertheless, as you say, the market is hanging on to every single sort of adjectives that is slightly positive. And don't forget, the backstory here is also that the market is now almost 100% certain that it will be a 25 basis point cut in the Federal Reserve's rates.
Yeah. Interesting to see if the Fed is sufficiently ahead of the curve, and that goes to what is the state of the economy, regardless of what the Fed is doing, regardless of this trade deal. To me, there's not really any upside risk to what's already going on in the economy. It's more about whether we're moving or keeping in place a downside risk. But one of the areas we're seeing, I thought this was a remarkable chart you tweeted out from Commerzbank. This eurozone loan data. This is just incredible stuff, and not just at the non-financial corporation level. That's the very ugly chart showing, I guess, I can't see the scale there, 6 to 7% year on year, but the household is actually slipping into negative. So there was this idea that eurozone growth stabilizing a bit, but this kind of data suggests that the credit impulse is really starting to fail badly.
It is extremely weak, and this is also why inflation is coming off, and it is because of the ECB to some extent, because the low interest rate, the negative interest rate, means that there are no appetite for investments. What we see in the case of, for instance, Germany, of course, is as we have negative interest rates, Germany continues to export capital to other countries that has a higher return on capital. So this is an immense problem for the restarting, for the awakening of the European sort of growth and activity level. And this is going to hurt the politicians and the European parliamentary election, but in every single parliamentary election that we see incoming, including our own here in Denmark.
Right. And if we look at Italy yesterday, getting some headlines with Salvini out saying that Italy would be happy to ignore some of the budgetary rules until it gets its unemployment rate down to 5%. We're finally starting to see the bond market waking up a bit more. It's kind of grinding, but we're still getting to interesting levels. I have a chart here of the 2-year BTP yield. It's towards the highs that it's been really in 2019, and some 60 plus basis points from the lows. What are we going to get out of this? We have these parliamentary elections coming up in just over a week, Steen. What are we going to get out of this? This is going to be a pretty dispersed result. Lots more Euroscepticism, but it's not a really concentrated vote.
So I think the global trend in politics is that every single party, every single sort of political fraction that was in the spectrum was all playing to convention. They were all conditioned to be inside the convention. It was very dangerous to be seen outside the convention. I think every single party, every single person, it's flipped. Every single person outside that looking in is actually gaining massively. So the very quick sort of analysis here is that the fractional, the non-conventional party would do extremely well in the European parliamentary election. It's right now the polls have been indicating 20%. I would not be surprised if we see north of 25% for parties and fractions that are non-convention sort of adhering.
Yeah, we'll have to look at that result in just over a week's time and put together what we think the response is going to be, both from the ECB and from the EU Commission as we head into November, where we have a complete leadership changeover. We've talked about that recently in a podcast, but this is going to be an interesting 2019 for Europe. Just want to mention a couple of things here. Aussie dollar, let's look at a chart here. We've finally broken below those low daily closes from back at the beginning of the year when equity prices were cratering. The RBA has linked its decision to cut to the jobs market. We saw an NAB survey in which the employment index showed the worst results since early 2016. We've got the jobs data up tonight. It's breaking down. The question is whether it can really extend aggressively as long as China is maintaining that floor. We flagged a short signal on our breakout model yesterday, but this is an interesting one to watch overnight. That whole attempt for yields to rally a bit on the RBA, insisting on not cutting just yet, that has been erased. So I think we're primed, if we get a weak jobs number, primed for a pretty interesting situation for Aussie overnight. And I just want to highlight very briefly, U.S. grains market. I think this is a fascinating story. If you're not trading grains or you don't ever look at the market, have a look at it. It's very interesting because we have the corn planting incredibly far behind. I have a chart here for a series of charts from our head of commodity strategy, Ole Hensen. And you see in the top left there, the black line showing the current planting progress report. All of the flooding preventing, the wet ground preventing farmers from getting the crop in. And finally, on the right, you're seeing the price chart. We have a very generous supply glut situation, but of course, we're looking at the forward crop and wondering whether that is going to get planted and whether it will be a bad harvest. So, and record shorts out there, that sets up for an interesting and potentially huge volatility expansion. If you're looking for something that's moving a lot, grain certainly moving more than FX these days, and in some cases, equities. Let's look at our macro calendar. We have a oil market report out this morning. Eurozone Q1 GDP could be interesting there. The first U.S. Regional manufacturing number up at 12:30, and I think an interesting one, the retail sales. It's all about the U.S. consumer. If you're looking at the U.S. economy, we've seen some pretty volatile month-to-month retail sales reports, so we might get a sense of a trend or a development there. And then we have, again, that Australian employment change data overnight. Also keep in mind for Australia, you have an election coming up in which the left-leaning party is expected to win. Classically, you look at the left-leaning, left of center being the less economically friendly or investment-friendly environment, fair or not. So keep that on your radar as well if you're trading Aussie. That'll do it for now, and we'll be back tomorrow with another edition of the Saxo Bank Morning Call. Thanks for joining.